In 9 months, Amazon saved $2.4 billion in taxes. The reason is a loophole in how stock pay gets taxed. It quietly shapes your own tax bill, too. Corporations report one number to shareholders and a much bigger number to the IRS. This is not a small company with a clever accountant. This is Amazon, in a filing with the Securities and Exchange Commission. The filing covers the first 9 months of 2024 alone. Big companies don't just pay executives in cash. A large part of executive pay comes as company stock. Those shares are promised today, handed over later. Companies like paying this way. It ties an executive's paycheck to the company's stock price. It also means less cash leaving the bank right now. Stock pay has grown common at large public companies, especially in tech and retail. It rewards executives when the business does well. It also opens the door to this exact gap. Here is where the loophole begins. The company makes a promise, then reports a small number to investors. Years later, it cashes in the real value and deducts more from its taxes. Same promise, same stock. 2 different numbers, one for investors, one for the IRS. The 2 numbers are rarely close. A stock price can double or triple between the promise and the payout. Every one of those extra dollars becomes a bigger tax deduction. Picture a stock grant worth $50 a share on the day it is promised. By the time it is cashed in, that same stock is worth $150 a share. The company still reports $50 to investors, but deducts the full $150 from its taxes. This is not unique to one company or industry. Any business that pays workers in stock can use the identical gap. It works the same in technology, retail, and finance alike. The company never spends any new cash to earn that deduction. The value simply appears on paper, tied to a price it never paid. Shareholders cheer the same number that shrinks the tax bill. None of this requires breaking any rule. It requires only that the stock price rise between the promise and the payout. That is exactly the outcome every shareholder hopes for. For an ordinary worker, income is income. It gets taxed once, the moment it lands in a paycheck. There is no earlier, smaller number available to report instead. Consider Marcus, a warehouse shift supervisor in Ohio. He pays 22 cents of every dollar in federal income tax, withheld from his paycheck. His employer used the same gap to legally shrink its own tax bill. The mechanism is simple once you see it. A rising stock price helps shareholders and grows the tax deduction. The company benefits twice, when the stock climbs and when it files taxes. That double benefit happens automatically, built into the rule itself. No one at the company needs to ask for it each year. This is not a theory. It is documented 3 separate times in public records. Point 1 is Amazon's own SEC filing, covering the 9 months ended September 30th, 2024. The company reported a net tax benefit of $2.4 billion tied to stock-based pay alone. That is money the U.S. Treasury did not collect in 9 months from one company. $2.4 billion is not the company's entire tax bill. It is only the portion tied to this one accounting gap in 9 months that is disclosed in a single line inside a single quarterly filing. This was not a one-time event buried in a footnote. Amazon's filings show this pattern repeating year after year as its stock price climbs. The higher the share price rises, the larger the deduction on the next filing. One company's filing is a strong data point on its own. It becomes something larger once you see the same gap at hundreds of other companies. That is exactly what the next figure shows. Point 2 comes from the Institute on Taxation and Economic Policy. ITEP found Fortune 500 corporations avoided $64.6 billion in taxes over 5 years. Same mechanism, company after company. not one filing, but an entire system. That figure does not describe one bad actor cutting corners. ITEP traced it across the country's largest, most profitable companies. $64.6 billion is a system working exactly as designed. $64.6 billion could cover the annual budget of dozens of mid-sized federal agencies. It did not disappear. It simply never arrived in the first place. $64.6 billion over 5 years works out to more than $12 billion a year. That is the annual scale of this one loophole, before counting anything else. None of these numbers come from leaks or anonymous sources. They come from public filings companies are legally required to make. The ITEP report is built entirely from that same public data. Point 3 is the rule that makes this legal in the first place. The Financial Accounting Standards Board sets the small number companies show investors. The tax code allows the much larger number once the stock is actually cashed in. That rule was not written to reward or punish any single company. It applies to every business that pays workers in stock, big or small. The size of the benefit depends only on how far the stock price climbed. This gap was not always there. Before 2006, companies did not have to report any expense for stock pay at all. A rule change forced companies to start expensing it, and this mismatch was the result. This is not new legislation from either political party. It is a structural gap that has existed for years, quietly, across administrations. A rule, not a headline. A sweeping new tax law passed in the summer of 2025. That law left this specific mechanism untouched. The gap between the shareholder number and the tax number is still open today. Companies do not hide any of this. They disclose it every quarter. In filings, almost no one reads. The disclosure is public, even if the billions in uncollected tax rarely are. Go back to the number that opened this video. $2.4 billion in 9 months from one company. That number is not a scandal hidden in the shadows. It sits in a public SEC filing, disclosed exactly the way the law requires. That is what makes it worse, not better. Nothing here needed to be hidden, because the loophole was built directly into the rules. The gap between the shareholder number and the IRS number is not a mistake. It is a feature, written into how stock pay has been taxed for years. Every dollar collected through payroll withholding funds, roads, schools, and programs ordinary families rely on. Every dollar routed around by this loophole gets covered somewhere else instead. Remember Marcus, the warehouse supervisor. His tax rate is fixed to his paycheck. There is no gap for him to walk through, no smaller number to report instead. If you have ever held company stock through work, this is not the same benefit. The deduction described here belongs to the corporation's tax return, not yours. Your gain gets taxed the ordinary way, the same as any paycheck. That asymmetry is the real story here. Not that companies pay executives in stock, or that stock prices rise. It is that the same promise gets taxed differently, depending on who made it. This is not a story about villains twirling mustaches. It is a story about a rule that rewards one kind of income over another. That rule was written into the tax code, one clause at a time. None of this requires outrage to understand. It requires looking at where the numbers diverge and asking who benefits. Once you see where the gap lives, a shrinking corporate tax bill stops looking random. Some of that $64.6 billion is still being claimed today, filing by filing. Multiply one company's $2.4 billion across an entire stock market. The scale becomes clear fast. This is the story behind the ITEP number, repeated thousands of times every year. The next time a company reports a lower tax bill, look at the stock price. Often, this gap is the reason, not fraud, not a mistake. Simply the rule, working exactly as written. A falling tax bill is not always about falling profit. Sometimes it is about a rising stock price and a loophole doing its job. A shrinking tax bill and a rising stock price are not two separate stories. They are the same story, told in two different filings. This same pattern shows up protected by law, not just accounting. Watch how Congress made a $12 billion overdraft fee structure permanent in a different industry. Same gap, hiding in plain sight,